Hello, and welcome back to my channel, The Dividend Investor, your one-stop shop for all things investing and personal finance. Today, we're going to talk about a financial strategy that has been gaining popularity in recent years, the Dividend Snowball Strategy. This strategy involves reinvesting the dividends you receive from stocks or mutual funds back into the same or similar investments, creating a snowball effect that leads to substantial growth over time. So, let's dive in and understand exactly how this works. What is the dividend snowball? Well, a dividend snowball is a way of reinvesting the dividends that you receive from stocks or mutual funds back into the same or similar investments. The idea is to use the dividends received to purchase additional shares, which in turn generates more dividends, which you then use to buy more shares, creating a snowball effect that leads to substantial growth over time. Let's take an example to understand the concept better. Imagine you have £10,000 invested in a stock that pays a dividend of 4% annually. That means you receive £400 in dividends each year. Instead of spending that £400, you reinvest it back into the stock. The next year, your investment will now be worth £10,400, generating a dividend of £416, and the cycle continues. As you can see, the investment is growing faster and generating more income over time, creating a snowball effect. So, what are the advantages of the dividend snowball strategy? Well, firstly, it's compound growth. The primary advantage of the dividend snowball is that it allows for compound growth, meaning that the dividends you receive are reinvested back into the same or similar investments, leading to even more dividends and more growth over time. Number 2, diversification. By reinvesting dividends, you can potentially build a more diversified investment portfolio as you purchase additional shares in different companies or industries. So, let's say you have invested £10,000 again invested in 2 different stocks, each paying 4% dividend annually. You reinvest the dividends back into both stocks, allowing you to purchase additional shares in each company. Takeaway number 3, dollar cost averaging. By reinvesting dividends on a regular basis, you are able to purchase additional shares at various prices, which can help average out the cost of your investment and potentially reduce risk. So, in the example of the £10,000 of stock investments that pays a 4% dividend annually, over the next 5 years, the stock price fluctuates, with some years seeing a higher price than others. However, by reinvesting dividends on a regular basis, you're able to purchase additional shares at various prices, potentially reducing the impact of short-term market fluctuations on your investment. That being said, there are a number of disadvantages that you should be aware of a dividend snowball strategy. Short-term volatility. By reinvesting dividends, you may be increasing your exposure to short-term market fluctuations, which can potentially impact the value of your investment. So, sticking with the example that we've already introduced, over the next year the stock price might drop significantly, leading to a decrease in the value of your investment. By reinvesting dividends, you may be increasing your exposure to short-term market fluctuations, potentially leading to a decrease in the overall value of your investment, at least in the short to medium term. Secondly, there are tax implications, which is different country to country, but reinvesting your dividends may result in additional taxes owed, which can impact the overall return of your investment. And thirdly, the opportunity cost. By reinvesting dividends instead of using the income for other purposes, such as paying off debt or saving for a large purchase, you may be missing out on other opportunities to improve your financial situation. For example, let's say you have a significant amount of credit card debt that you're struggling to pay off. By reinvesting dividends instead of using the income to pay off the debt, you may be missing out on the opportunity to reduce debt and improve your financial situation. It's important to carefully consider the advantages and disadvantages of this strategy before incorporating it into your investment plan, and to consult with a financial advisor to determine if it's appropriate for a specific financial goals and situation. But in summary, there's 4 key points here. The dividend snowball is a financial strategy that involves reinvesting dividends received from stocks or mutual funds back into the same or similar investment. Advantages of the dividend snowball include compound growth, diversification, and long-term dollar cost averaging. The disadvantages of the dividend snowball include short-term volatility, tax implications, and the opportunity cost. Before incorporating the dividend snowball into your investment plan, it's important to carefully consider the advantages and disadvantages and see whether this fits into your long-term investment plan and your specific goals and situation. Remember, investing always involves risk, and it's important to have a well-diversified portfolio and a long-term perspective. As always, do your own research and consult with a financial advisor before making any investment decisions. And once again, that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.